Let's talk about the costs to speculate in the two markets. What are the capital requirements and costs to speculate with futures versus stock options? The initial capital requirement and cost structures vary significantly. Futures trading generally requires a higher initial margin and comes with daily settlement risks, as well as maintenance margin requirements. Whereas stock options trading can be initiated with a lower capital outlay premium paid, offering a higher risk-reward ratio for the capital invested. Let's start by discussing the capital requirements and costs to invest using futures trading. Futures trading often has higher margin requirements because it typically involves higher initial capital due to margin needs. Traders are required to deposit a margin, which is typically a fraction of the total contract value, to hold a position in futures. This margin serves as a form of security against potential losses. The need for a margin deposit, which can be a significant portion of the contract's value, can make futures trading less accessible for traders with limited capital. Futures contracts are subject to daily settlement, meaning the profit or loss on the contract is adjusted at the end of each trading day. This process, known as mark-to-market, can lead to daily margin calls if the market moves against the trader's position. Traders must be prepared to meet these margin calls, which can require additional capital and add to the overall cost of trading futures. While leverage in futures trading allows traders to control large contract values with a relatively small amount of capital, it also amplifies both gains and losses. This can lead to significant financial risks and additional costs if market movements necessitate frequent margin adjustments. In contrast to futures, stock options trading can be initiated with a lower capital outlay. When buying options, traders pay a premium, which is the cost of the option. This premium is typically much less than the cost of purchasing the underlying stock outright, making options trading more accessible for smaller investors or those looking to reduce upfront investment. The premium paid for buying an option represents the maximum risk for the buyer. This means that the potential loss is limited and known upfront, offering a more favorable risk-reward ratio, especially for conservative investors or those new to trading. The ability to define risk clearly is a significant advantage for options traders. While the initial capital requirement may be lower in options trading, implementing more complex strategies can involve additional costs. These include brokerage fees, especially if the strategy involves multiple transactions, and potential costs associated with time decay, otherwise known as theta, particularly for options writers or those holding long-term option positions. The choice between futures and stock options trading should consider both the initial capital requirement and the ongoing costs associated with each type of trading. Futures trading, while offering the potential for substantial gains, requires higher capital investment and comes with the risk of significant additional costs due to daily settlements and margin requirements. In contrast, stock options trading generally allows market participation with a lower upfront investment and a more controlled risk profile, albeit sometimes at the cost of additional complexity and potential time decay. Investors and traders need to weigh these factors against their investment goals, capital availability, and risk tolerance to choose the most suitable trading approach. The intricate tapestry of futures and stock options trading, each with its unique strategies and market approaches, offers a vast landscape for investors to navigate. These two distinct realms cater to diverse trader profiles. Futures trading resonates with those seeking a direct, high leverage approach to market direction,